Hello, everybody, and thanks for joining us. This is John O'Connor. I'm president of 3D Asset Management, and this is the most current session in our Advisor Success Series, this time with Gladstone Associates. 3D Asset Management is an investment manager. We're based in Hartford, Connecticut. We've been in business for almost 12 years now and provide outsourced investment management services to advisors around the country in the independent broker-dealer space, RIAs, and regionals on several industry platforms, as well as our white glove service level turnkey asset management program. Today we're going to hear from Gladstone Associates about sell-side readiness. And Gladstone Associates is a specialized investment bank with a singular focus, guiding independent financial services firms through transformative events, primarily designed for independent investment advisors with $350 million to $5 billion in assets under management. Gladstone assists owners who are either seeking to retire, sell, or transition their businesses, or who want to grow their businesses via acquisition and/or merger. Their clients include asset managers, wealth managers, family offices, financial advisors, and money managers, along with regional and community banks, broker-dealers, fintech platforms, and private equity funds. Gladstone was established in 2006, and their home office is based just outside of Philadelphia in Plymouth Meeting, Pennsylvania, from which they provide services to clients nationwide. Our presenter today is a principal with Gladstone Associates, Michael Bellata. Mike is the president of Gladstone and has over 17 years of experience in the financial services industry. Throughout the firm's history, Mike has been instrumental in the overall management and strategic direction of Gladstone. With past experience in the financial services industry, relationship management of registered investment advisors, and commercial banking with super regional bank, Mike identifies with the goals and objectives of clients and is able to provide with insight to the mechanics and psychology of a successful transaction. So with no further ado, I'm going to hand it over to you, Mike. Welcome.
Hey, thanks, John. And good afternoon, everyone. As John had pointed out, today we're going to be talking about sell-side readiness for independent firms in the financial services space. So just so to be clear, you don't have to be an active seller to benefit from this exercise, since it should provide food for thought if you're only contemplating or filing away for future days. And having said that, those interested in buying a firm could get some insight into a seller's psyche and pick up a few ideas of what to look out for when evaluating a firm. So let's get started. But when business owners determine it's ready to sell the firm for whatever reason, it could be liquidity, retirement, even selling to grow, it's not as easy as simply making an announcement that the firm is for sale and all of a sudden they're at the closing table. Potential sellers need to be aware of what drives value and what might diminish value. They also need to know their options when it comes to suitors, and quite frankly, they need a self-assessment of what life could look like post-transaction. So thinking about the profile of an entrepreneur, you all are type A drivers. And this last point is incredibly important. It's not just the dollar amount of a transaction, but the peace of mind coming away from a transaction. So it's much more involved than simply putting up a firm on the block and waiting for suitors to show up. It's about evaluating if you are mentally, financially, and emotionally prepared to sell your baby. And for this presentation, I'll provide some of our industry observations historically, as well as comment on the current state of the industry. And we'll then walk through a tool that we developed internally to actually help us assess if a potential Gladstone client is ready to embark upon a sell-side process. And in simplest terms, our process relies on a variety of separately weighted key performance indicators, or KPIs. We look at different areas of a firm, and it's important to note that largely these attributes are non-financial, but will certainly have a financial impact when the time comes. So the exercise, it's a simple Q&A, participants answering yes, no, and maybe. That really gets to the heart of what makes up a firm, and it gives Gladstone the opportunity to dive pretty deep with a potential seller. So walking through this process helps demonstrate to us not only the durability and transferability of a business, but the mental readiness of the business owner, perhaps the more important of those three items. But for the moment, I'm going to step back, go back in time, and give you an historical vantage point of what Gladstone has seen. And we've witnessed a lot of change over the past decade. In fact, my tenure at Gladstone goes back more than a decade. And I usually recount when I first walked through the doors about 11 years ago, a firm with $100 million of assets was one of the larger firms in the space. Now we're seeing $1, $3, $5 billion independent firms, which is exciting to see from our perspective, but the independent space is still a cottage industry. And while there are many, many RIAs in the space that fall in terms of assets between $100 million and $1 billion of assets, there are still more than 14,000 additional RIAs that have assets less than $100 million. So that's staggering. It's a very big, but yet very fragmented space. And keep in mind that we are still in a first generation of leadership in the independent channel, meaning most founding principals are still in a management position or a leadership position. So we recognize that the age demographic of these folks is approaching mid-60s, and most are without a succession plan, whether internal or external. Add to this that compliance is getting increasingly burdensome as firms need to be more vigilant. Technology is quickly getting developed and outdated just as fast. Margin compression continues to threaten RIAs, and finding good quality junior advisors is easier said than done. But considering all of this and that the space is still fragmented with thousands and thousands of firms competing for business, and if you think for a moment, you'll conclude that any industry with this type of dynamic is ripe for consolidation, and that's exactly what has been occurring. And what we've seen over the past 10 years are several roll-up or aggregation models aggressively acquiring RIAs. And I'm sure many of you are familiar with those business models, and they've been very successful, amassing billions of AUM and providing an elegant succession solution for our RIAs. And they have done a terrific job of bringing light to this opportunity. But I think in 2017, they're not the only games in town. So potential sellers, from Gladstone's standpoint, are much more in tune with what drives value and what may capture the attention of a potential suitor. And they are increasingly acknowledging the value of self-assessment. So transitioning to Gladstone, our philosophy is that any kind of selling strategy cannot begin without a thoughtful assessment of business objectives and personal objectives. It does take time to develop a strategy, not only what you want, but establishing timelines, expectations, and frankly, what defines success. Unlike selling a product or a service, this is a highly emotionally charged process for a seller, so taking the time to understand the mechanics of a sale is paramount to success. So a few thoughts about privately held businesses. Most RIAs were founded and are still managed by a single individual, many of which are the heart and soul of the organization, not to mention the person largely responsible for business development and cash flow. As owners, you are masters of your domain. A suggestion to leave all of this to another has to be pretty compelling. Are you ready for this? Is what we're trying to answer. Most RIAs going through a transaction is more than likely a first-time experience. Fear of the unknown can be paralyzing, especially considering this industry compensates owners very well. So that is enough to put the brakes on for many. And as I mentioned a few moments ago, that we're still first generation of leadership, most firms that we encounter started from scratch, attained a level of success through long hours and hard work from the founder, blood, sweat, and tears. And what we see in many cases is that if there is a second level of advisor at a firm and an internal succession plan is on the table, far too often owners realize NextGen does not have the entrepreneurial gene, nor do they have the financial wherewithal or appetite for risk required to take out the owner. So in many cases, many owners are left to remain status quo or look beyond their own firm for a third-party transaction. So when considering an RIA owner's largest asset, it's likely the business. So passing its management off to another can be a difficult pill. Add to this that cash flows of independent RIAs is very, very admirable to outside industries. That too has to be addressed with a strategy. And finally, we talked about the changing compliance and technology landscape. These things require attention, they require time. And considering how much time an advisor really has available, these types of obligations can be diversions to why someone got in the business in the first place, to help counsel clients. Maybe plugging into a larger firm with size and scale and continuing to work with a partner can be very rewarding, but the process is really about considering options and evaluating if you are indeed ready. So Gladstone's approach to sell-side readiness is to view a firm for sale from a buyer's point of view. Financial statements, they only tell a portion of the story, considering there are many, many, many non-financial attributes that need to be addressed to determine not only the value of the organization, but as important, the ease of integration and protecting the underlying asset, the client relationships. So think of the process as selling a house. To get the most favorable price, you'll inspect the roof, freshen up any paint, clean the house from top to bottom, make sure landscaping is impeccable. After all, you will be inviting folks into your firm to look from the inside out. The saying first impressions are lasting impressions couldn't be more true. So when Gladstone evaluates the qualities of a firm that is contemplating a sale, we'll look at three general categories, which we'll break down further in this presentation. We look at a firm assessment, a strategic assessment, and an ownership assessment. The firm assessment, as you may guess, focuses on the actual business enterprise, not from a financial point of view, but more from a mechanical or structural viewpoint, ranging from corporate structure to employee relations. Some may seem minor, but taken collectively, they can be pretty impactful. By the way, at the end of this presentation, we will email this assessment, the Q&A for you to complete and return to us for your personal assessment. But for now, we'll walk through a selection of the actual questions and why they're important. So when you are completing your own Q&A, you'll have a better understanding of this exercise. The first question we asked, does the firm have a mission statement? Is it the end of the world if a firm doesn't have one? No, but it can set the tone of a strong corporate culture if all employees know it and are guided by the mission statement. It could be a strong sense of service that is appealing to a buyer. Again, we're viewing a potential selling candidate from a buyer's lens. Does the firm have a written strategic business plan? By the way, written is the key word in that sentence, and I'm not talking about the desire to grow 20% a year, but are there metrics and timetables and consequences and rewards associated with a business plan? This demonstrates structure and commitment. Part two of that question, has the business plan been executed over the past 3 years? And that's pretty important. Do you even know where the business plan is? Again, a plan has to be continually revisited and updated, otherwise it's useless. Does the firm have an advisory board or a board of directors? Very important for the reason that third parties, particularly those not necessarily in financial services, can be incredibly objective when it comes to counsel and critique. If entrepreneurs have no one to answer to and don't take outside advice, this can be unintentionally misguided. And of course, not always the case, but may avoid a situation where the emperor has new clothes. Like the business plan, an advisory board or a board of directors has to meet regularly in order to be effective. It's not just a showcase of the prominent folks you know. Another, shifting gears to corporate structure, has the corporate structure been reviewed in the past 3 years? This is important, as the business has to be treated like a business, not just on autopilot as long as the cash flows are positive. Does the firm have employee retention mechanisms, meaning employee agreements, non-compete agreements, non-solicit agreements? Employees need structure too. They need to know what they can do and what they can't do. They need to know what their roles and their responsibilities are. Structure is very, very important. Perhaps more important, we are well aware of firms or know of firms that lost a slug of assets on account of a falling out with an employee that walked away with clients. And the owners were helpless since the employee quote, owned the client relationships. Non-compete agreements and non-solicit agreements are only mildly effective, but a non-accept clause can be a very effective deterrent to an advisor leaving with client relationships. In this scenario, if an advisor were to leave with firm clients, he or she should have to pay the owner for those assets at a predetermined valuation. This is enforceable and very important to a prospective buyer, since it does mitigate risk of advisor flight. The financial management of a firm is a central point. Does the firm have a formal budget project? process? And does the firm have formal growth models? This shows a seriousness and a business-like attitude to a firm, not just hoping for new business and managing expenses by a monthly cash flow. A buyer wants to see predictability and good fiscal management. This is very helpful to a buyer as they can better assess their return on investment. That could mean extra dollars for a seller. Growth. Growth of a firm is a very big deal, especially in this market. After all, it's been close to a 10-year bull market. And if a firm is not growing, especially in this environment, they're likely shrinking. So we ask a firm, is it growing at least a 10% growth rate, net of market gain? And it is one thing to benefit from favorable markets, but it's quite another to continually add new clients and add new assets. We ask if a firm has a proven growth strategy. Again, strong markets will lift AUM-based firms and could hide slow growth. So there are plenty of bull market entrepreneurs in this space, but we try to identify where that lift is coming from. But a growth strategy, more importantly, a proven growth strategy will indeed make a firm a true standout. We do see most firms in the space grow by referral, which is fine, but if there is a strong sales culture at a firm, that can be very, very compelling to the right buyer. And from a buyer's perspective, that could be potentially leading to higher consideration of the firm because of that sales generator within an organization. Scale. There is a lot of talk about scale in our industry, but sometimes it seems like the definition is subject to interpretation. Some things that we look for are repeatable systems and processes, both internally and externally. Repeatable systems and repeatable processes. Are clients hearing the same firm story, and are they managed through the same identical process? Internal systems. Are employees aware of a career path, and do they know what allows them to advance? These are aspects where corporate culture begins to be defined. When all principals, advisors, and associates at a firm are performing with consistency, that makes client management very efficient, and this knowledge can be transferred to new employees walking in the door. That's a pyramid effect. If you think about it, food and retail chains figured this out a very long time ago. McDonald's, Starbucks, Disney, the U.S. Armed Forces even. It's a common modeled experience that is repeatable and efficient, and most important, not subject to interpretation. So when a buyer is looking at a possible seller, they look for a reasonable amount of structure within a firm, not the Wild West. A few day-to-day differentiator. We'll get into the nuts and bolts of how a firm performs against their peers in the market. We ask, is the firm close to a major metro center or wealth center? Boston, Chicago, Dallas, LA. This doesn't mean firms outside these large markets are at a loss or somehow discounted, only that greater wealth pockets mean greater opportunity for growth. But in the same breath, they also have a lot more competition. Investing. How does a firm approach investing? Are investments managed in-house or are they outsourced to a third party? And this area seems to be going through a transformation more and more as firms are evaluating third-party investment management. Especially among smaller firms, they may not have the resources to compete and keep up with managers that focus exclusively on investments. Planning groups may view the investment piece as only a cog in the advice and planning process and feel that outside parties can be more effective as PMs. But from a buyer's perspective, it really depends on how they are structured and what compatibility can be found. Something that is gaining in importance more recently, and we do have to address Generation X and Millennials. We talked about the industry being first generation of independent firms, and average principals are well into their 60s. Well, these principals are in an aging demographic, and if a group has an aging demographic as a client base and has done little to forge relationships with second and third generations, this has a profound impact on value. Your assets are not fixed, they have legs. It's risky to a buyer to assume a client base in the first place is going to make the transition. Add to this, if an average client age is say 70 plus years old, that's an eroding asset, much less appealing than a group with G2 and G3 relationships. And this is incredibly important. And as an aside, for the first time, I'm seeing unsellable businesses. where the client base is just too advanced in years that buyers are passing and looking for more youthful or multi-generational client relationships. Some sellers simply waited too long. When we discuss value, it's certainly going to be at the forefront of a seller's mind. We do ask principals if the firm has been formally valued in the past 2 years, at least. That demonstrates a serious corporate planning aspect and lets us know that the seller has a reasonable expectation or at least some basis of value. If not, does the firm have an idea of its worth? Do they know how firms are valued in this space? And oftentimes we speak with groups where they're not thinking in terms of fair value, but funding their retirement. These two numbers can be very, very far apart. And by the way, a sale doesn't mean that the owner cleans out their desk the day of closing. More often, buyers want sellers to stay not only for ease of a client transition, but for the gravitas. I'd take a 60-year-old advisor over a newly minted CFP any day, but that's just me being judgmental. There is a lot of value, a tremendous amount of value in real-life experiences, and you can put a price tag onto that. An increasing trend we're seeing because firms are getting more and more sophisticated, mergers are becoming more prevalent in the space, where groups that have a complementary fit can be very harmonious partners. Not where A swallows B, but where key aspects of each group are retained and when combined make a better firm. I hear the analogy 2 + 2 = 5. That's the same kind of concept. So we do ask sellers, would they be open to the scenario, as it could be very appealing to the right buyer and coincidentally the right seller. We do ask the seller if they have sufficient capital to say no to a buyer. This is really about leverage and negotiation. So if a seller has insufficient assets and is forced to sell a firm, the result may be a less than ideal scenario where a seller can't be too choosy and may be pressed for time. That's probably not the best time to sell a firm. But now we're moving toward the strategic assessment of our readiness platform. We do ask a firm if it's publicly for sale. Is it public knowledge? This could be a risky situation if competitors know and try to cannibalize the selling firm's clients. Employees of the selling firm, they may have the jitters as there's a high degree of uncertainty when it comes to self-preservation. Will they keep their job? We'll also ask if a firm has been for sale in the past 3 years. If they didn't sell, what happened? Did no one want to buy them? Was their value expectation too unrealistic? Or was it deal fatigue from looking for a Prince Charming that didn't exist? And coming from an owner's point of view, owners usually know who their competition is, and they're probably familiar with groups they respect and think there's a connection to a possible combination. So we'll start there with the seller. Do you have a favorite suitor? Most sellers are initiated to M&A when they're going through this process to sell their own firm. So sometimes there's a learning curve of what a transaction could look like and will look like. And considering there's no one way to structure a deal, it can be pretty challenging with all of the moving parts, but simply to the basics. Does a seller know the common currencies of a deal? Cash, stock, notes, earnouts? Also, since these deals are contingency sales, is the owner okay with that? Can they afford an installment sale? These questions will prepare a seller for what will come in the process and set the expectation. A few points about the ongoing management of a firm. Assuming there's a second line of management, are they committed to a transition? A buyer needs to know this, as it could present a significant risk of employee flight with clients, not to mention remaining employees, especially those with client relationships. They can make things very difficult for the seller and hold them hostage for some kind of demand, a raise, a bonus, some kind of retention amount. It happens. Will the second line of management participate in the sale? That could be problematic again, holding the seller hostage. These scenarios seem kind of bleak, but they do happen. Seller need to be aware of this possibility. And again, sales don't happen overnight. There is a time commitment and an obligation to a process, so we will prepare a seller for this. If day-to-day is so burdensome where extra time spent in another area could be detrimental to the business, it might make sense to postpone a sale for a bit. And this leads to the point that an exit doesn't necessarily happen after closing. Typically, there is a time obligation to the selling party to remain for some period, sometimes a few years. Is that expected? Also, does the seller want to participate in growth post-sale? That can be very appealing to continue rainmaking and benefit for these efforts. Far too often, sellers feel that if they sell the firm, all of a sudden they're going to be out of a job and left to their own devices. But again, the gravitas, they can be a very welcomed addition to a buying firm, and can be a very, very respected member of the management team. We also ask, relating to the currencies of a transaction, does the seller have an expectation of a down payment? Usually it's a reasonable fraction of total consideration, but far from 100%. We have to manage seller's expectation. Are they thinking in terms of 20% down payment, 50% down payment, 80% down payment? So that we do have to discuss the expectation of the currencies. Is there a need for the proceeds? I would never rush into this process, but a need to sell is a red flag, and we would have to dig in for those true reasons. Poor personal financial management, divorce, anything. We have to know, and a buyer would certainly want to know that as well. Sometimes the right suitor is not found. Would a seller accept that fact and go back to running the business and address another day? So if a firm has to sell, again, that could result in a less than ideal outcome. And now we're getting into the ownership assessment. Does the firm have a written and viable succession plan? This shows a seriousness to firm management and consideration of client welfare. It acts as a protection mechanism for clients should something happen to ownership, and it establishes continuity. We'll ask if second line of management is in place and ready to lead. If they're not, and the owner is key to success and client relationships, that could mean added risk to a buyer if the seller is no longer involved and second line of management is not ready. And we touched on this earlier, employment agreements. This is very important. If there are no agreements in place, it could be easier for an advisor to slip out the door with clients, more risk to a buyer. And in terms of continuity, we will ask if employees want to buy the firm. If they do, and it's not offered, that could be risky to a buyer if they have disenfranchised employees. If employees don't want to buy, I'd want to know the reason. Not enough capital to buy, or they feel it's a bad investment. The latter would give me pause. As it relates to an owner's personal preparedness, we again want to validate that there are ample personal assets outside the company. This ensures that a seller has to leverage and walk away from the deal if it's just not right. And finally, we'll ask the seller if they have a CPA or an attorney with direct M&A experience. Especially in independent financial services, this is very important that they're well seasoned in our space to provide adequate guidance toward the final stages of a sale. While the beginning of a transaction is about courtship, there will come a time when tax and legal take the forefront. It's all about expectation and preparedness. So that is the overview of our readiness assessment. It's really not about the financial attributes, but more the psychology of why a seller is going through this process and what to expect as far as possibly part of another organization and unwinding their baby and putting it into the hands of a new owner. So hopefully that was helpful as you're contemplating a sale or at some point in the life cycle of the business, or helpful for firms looking to potentially acquire an outside party. And I think we're reserving some time for some Q&A.
That's right. Thanks a lot, Mike. That was great information. We've got a few questions, but I want to remind everybody listening in, you can ask us a question in the Q&A section of the attendee panel. Here's a couple that have come in so far. When is the best time to sell my business? And it doesn't give a lot more definition than that. So,
Well, it's I think from the best time to sell a business. I think I mentioned in the presentation that some firms have waited too long because they have an eroding asset or an aging client base. So I think selling a firm from a position of strength does have a lot of benefit. So when buyers are looking at firms on the upswing, if they do have some serious growth behind them the past couple of years, they're looking at how the firm is transitioning from the first generation to the second generation to the third generation of client, and even from an owner's perspective, have multiple parties of ownership with the organization. But on the upswing, it's always better to contemplate a sale in that regard, because you will command a premium to the overall value of the organization. So if there's a firm on the downstroke, if they're losing clients, if they're losing assets, especially in this market, there's going to be some serious discounting on that valuation. So I would, as a buyer, I would be more favorable to buying a strong asset rather than one that is looking for a helping hand. However, if we do have clients coming to Gladstone, particularly buy-side clients, hey, we would love to buy just a strong, just a quickly growing organization that is very, very efficient and has the better years ahead of them. The question that comes up, well, if they're growing nicely and growing robustly more so than the buyer, then there's no reason to sell that business. I think if a firm is hitting all cylinders and they don't need any assistance, then from a buyer's perspective, how can I extract additional value from the organization? So if a firm is hitting a glass ceiling with good growth behind them, as well as good growth prospects, as well as some incremental inefficiencies that can be made right by the right buyer, that can be a very, very compelling organization where there's going to be, if there's I'll refer to the analogy of jewel in the rough. If a buyer can put some luster on that group, that helps the buyer, and frankly, the additional lift could help the seller. So to answer the question, when is the best time to sell the business? As you're peaking top performance and thinking that there is going to be a slowdown at some point in the not too distant future.
all right. Thank you very much. Here's another one. I've heard of Focus Financial, but are the roll-ups the only game in town? How about wirehouses or banks or large broker-dealers?
Yeah, it's, I mean, even from the past, I mean, Gladstone, we're a 12-year-old firm, and I think when I first, again, walked through the doors, some of the roll-ups, some of the aggregators, Focus Financial, United Capital, Wealth Enhancement Group, terrific organizations, very smart people, and they did a phenomenal job about addressing our industry. It's very rare that succession planning was taken seriously. To give you an example, when Gladstone was first established, we were quoting that 20% of the independent space had a bona fide succession plan. In 2017, I'm still quoting 20% of the industry has a bona fide succession plan. So it is still a critical condition of the space. And given the fact that the profiles that are still in a management position, they're 10 years older. So looking at Focus, United, some of the roll-ups, they've done great jobs. I think there are a more variety of aggregators that are in tune with specific situations. So are they going away? No. Have most of the firms in the industry have some kind of interaction with an aggregator or a roll-up or a consolidator? Probably. It's good to maintain that communication. It's good to have an understanding of what options are in the market. But when we look at how many transactions occur over a year-by-year basis, if whatever the published amount is, if it's 75 or 85 or 125, it's probably double or triple of that amount. Generally, the combinations that we see, they may have prior relationships with, two firms may have a prior relationship. They may be long-term club friends or industry friends that share maybe 10 or 15 years between them, and all of a sudden there's a seriousness to a business combination, and it's a whisper. It's not a headline. The aggregators do get headlines because they're in the business of acquisitions, and that is an elegant solution for someone who's looking for liquidity, needs some succession, needs some intellectual talent overlaid to their platform. But are they only game in town? No. One thing that we're seeing of late, regional and community banks entering the space, not only from their point of view. If you look at banks and their business model, loans and deposits, particularly in this interest rate environment, they're not the business model that they once were. They're being commoditized, heavily commoditized, and are looking for ways to diversify their revenue streams, and blending wealth or asset management into banking. That is a very complementary and can be a very harmonious relationship. So we are getting a lot of interest from regional community banks that either want to augment their existing platform or establish a wealth management or an asset management platform, not only to really mine those client relationships for bank product, but to enhance the overall end user relationship, meaning the client. So no, they're not the only games in town.
Excellent. Here's one. What deal structure is most commonly used when minority partners want to purchase a majority partner?
Yeah, well, the value is one aspect, structure is quite another, and they are inseparable. So I think that's a bit too specific. I would need to know greater detail about what the firm mechanically is about, even their business structure and some of the percentages, as well as some of the drivers of the firm. But I will opine as best I can. So if you're looking at an internal strategy, oftentimes there is a discount applied to the asset because there is an easy transition for the majority owner. It also is a very elegant solution because it's least disruptive to the client makeup. There's a familiarity with business, process, investments, even the client relationships. They're on a name-by-name basis. So there could be long-term timetables, and because a lot of times there's a familial relationship between, I'll say, a founding principal and maybe a junior that is making the overture to buy out the majority partner. Maybe there is a favorable timetable. Could it be 5, 10 years? Sure. There are thousands of ways to structure these deals, but I think it really does depend on what the buyer is trying to achieve and what the seller is trying to achieve. But those are very friendly, oftentimes very friendly conversations and very friendly business deals.
And just as a follow-up, this is from me. Do you help people with internal acquisitions like that?
We sure do. We sure do. And I think, when Gladstone approaches this subject, I mean, we make no presumption of anyone's objectives. So if a firm does want to buy or does want to sell, does want to merge internally, externally, a certain part of our process, or the initial stage of our process, is getting an understanding. Okay, what are you looking out for? What are you trying to achieve? And us basically tabulating and calculating, okay, from our experience over the years and the experience and the firms that we've discussed and the deals that we've put together, can we come back to our clients and give them educated opinions? So this is what we've heard, and these are your alternatives of your options. And some you may like, some you won't like, but it's really about assessing, okay, what are you trying to achieve, and us determining, yes, you can do that, or no, you can't do that unless you follow these steps first. So I think we're just looking out for not only the seller's best interest, but the buyer's self-interest as well.
Okay, and then here's one about, I guess, valuation in general. What do you think of revenue multiples or multiples of EBITDA or percentage of AUM?
Now, I think that's always a hot topic in this type of discussion, and I will say that I know as maybe everyone on this call is familiar with the two times revenue figure, and that does. I mean, it is a starting point. It does really highlight that firms have to have some kind of valuation perspective when it comes to looking at their own firm. But cost structures of two firms, A and B, one can have 40% profit margins, the other could have 80% profit margins, a third could have 20% profit margins. So I think the revenue multiple is a gross disservice to an independent business owner. And I think when you're looking at, well, these are by and large independent businesses on the smaller side in comparison to publicly held organizations. So if it's $1, $10, $20 million of revenue, you can make it's arguable that these are beyond nano cap businesses. So what we rely on, we will weave an EBOC evaluation looking at trying to identify true cash flow of the organization, and we will make adjustments. And typically in independent financial services, owner's compensation is the largest line item on a P&L. We recognize that. So we will make adjustments to normalize some of those compensation levels, normalize or add back some perks of closely held businesses, meaning country club memberships, or if it's a car or some T&E. I mean, there are some benefits to owning a business, and we will try to normalize those expenses. And we do rely on a line item on a P&L, EBOC, earnings before owner's compensation. As a buyer, that would tell me, okay, what is my reasonable cash flow if I were to make this acquisition? And it will help me determine what my return on investment is. So when you're talking about a 2x on revenue, listen, from a buyer's perspective, if they're trying to achieve a 19 or a 20 or a 21% return on investment, they'll effectively back into that multiple. However, we do rely on discounted cash flow. We will take into account business risk, the model risk, and market risk of organizations, and we will weave that into our assessment on earnings before owner's compensation. So less so on revenue, but a high degree of emphasis on true cash flow.
Okay, and it looks like this is our last one. I also own an insurance agency alongside my financial planning practice. Does it make sense to package them together or look at selling them separately? I would like to have greater detail, but I think it's a good starting point. I think when you're looking at business models, fee only versus independent broker-dealer model versus hybrid versus tribrid, meaning the BD, the insurance, and the RIA. I mean, there are a lot of business models. And when we do work with a group that does have just different components to the business, what we try to assess and through our evaluation is finding, okay, who are possible suitors that would gravitate toward that business model. So not only are we trying to find firms that do have capital to make an acquisition, but I mean, we're trying to identify the sameness on the service model, trying to find sameness on the investment piece, and trying to find sameness, probably the most important, on the people factor or the human element. So if a firm does have an insurance agency, is that 80% of the business or is it 10% of the business? How do the clients map over from the asset management clients? Are they the same client? So, I mean, it could make great sense to keep them together because that could be highly interesting to the right buyer. I think in that case, it could be an opportunity to almost be prepared to bifurcate that business model if it is a clean break, and assess, well, would this make sense if we were to sell the firm piecemeal? So I think it does depend on what the composition of the business looks like at this point, as well as what the audience could look like in the industry. Is it a small pool of candidates, or is it an ocean full of potential buyers? But I think it does have to make not only economic sense, but be accretive to the clients, quite frankly. Wonderful. Well, that's it for our questions. Thank you so much, Mike, and thanks to our friends at Gladstone. Um, you had mentioned that you would email out to all the attendees a questionnaire.
Yeah, no, that's right. Once we part from the webinar, each participant is going to be emailed the questionnaire, and it's not meant to be focused and give a hard look, but maybe more of an impromptu yes, no, or maybe on those calculations. So I would say maximum maybe a 15-minute exercise, and then submit back to Gladstone, and we'll prepare what that readiness score looks like. And it could be food for thought on from a potential seller, even if a sale is a glimmer, or can file away for a future date, or from a buyer's perspective. But I think it will be somewhat illuminating for a variety of candidates, and it's not a huge investment of time. So happy to provide that after the webinar.
Very good. Thanks so much. And thank you, everybody out there, for joining us today. Again, 3D Asset Management values your business and the relationships, and we want to be your outsourced investment management partner. And as Mike said at one point during the presentation, that having continuity of certain services, and in a lot of cases, the investment management service is key to your business. Look to us to be that outsourced partner and provide you that continuity. If anybody has any questions for Gladstone or Mike, their number is on the screen. If anybody has any questions or would like to follow up with us here at 3D Asset Management, go to our website, www.3dadvisor.com, or give us a call at 860-291-1998 and select option 2, and you'll go to our sales desk. So without further ado, thank you everybody for joining us today, and enjoy the rest of your week. Bye-bye.